The Sarbanes-Oxley Act of 2002 was created by Senator Paul Sarbanes and Congressman Michael Oxley. This act is also referred to as the Sox Act, Sox Act, the Public Company Accounting Reform and Investor Protection Act, and the Corporate and Auditing Accountability, Responsibility, and Transparency Act. The goal of this act was to protect investors from the fraudulent activities of the corporation, as well as enforcing stricter regulations for accountants, auditors, and other corporate financial officers. In addition, the Sox Act also introduces criminal penalties for violating any of these rules and regulations.
The Sox Act was formed in response to major companies committing fraud like Enron, WorldCom, Tyco, and Arthur Andersen.
Within the Sox Act, there are three major components to the Act. Within Section 302, it requires management to set up internal controls and sign off on all major financial statements. Within Section 404, it requires management to create internal controls and reporting methods. In Section 802, there are three key points. One point handles destruction and falsifications of files and records. Another point handles the defined time period to store these records, and another point handles the specific records needed to store. Within this act, there's also protection for whistleblowers, which protects employees who report fraud and or testify against their employers.
A recent example of a corporate fraud scandal is Danske Bank. The Danske Bank CEO retired after being discovered for an 8-year money laundering scandal. It is estimated that $234 billion was lost. He was caught in September 2018. Danske Bank is a century-old European banking company. The money laundering activities were specifically associated with the Estonian branch of the company that was acquired in 2006. This branch failed to prevent money laundering activities that involved over 6,000 customers in over 32 different currencies. After the investigation, Danske Bank faced a $2 billion fine for their money laundering activities.
3 internal controls over cash receipts. One option is to restrict cash access to only certain employees. A second option is to share duties. And a third option is to have each person compare their day's total cash in hand to what the computer says they are supposed to have.
Here are a few internal controls over cash payments. One option is to avoid at all costs mailing cash. Another option is to have on all checks require 2 signatures to authorize the check. And then a third option is to adopt an electronic payment system.